Welcome to the Deep Dive. We're here to unpack complex ideas and, well, really just make them clearer for you.
That's the plan.
And today, we are diving headfirst into something that gets investors really talking, sometimes arguing, market timing. Is it this mythical beast, this fool's errand?
Or maybe the ultimate edge, right?
Exactly. And our guide for this deep dive is Curtis M. Arnold's book, Timing the Market: How to Profit in Bull and Bear Markets with Technical Analysis.
Quite a title. Sets high expectations.
It does. And our mission here is basically to give you the essence of Arnold's thinking, the core ideas, the strategies, the tools he lays out. We want to help you sort through the noise, figure out what's just market folklore versus what might actually be useful.
And Arnold, he comes out swinging right away. He says technical analysis isn't just a way, it's the most reliable way to time the markets.
Yeah, promising maximum profits with minimal risk. That's a bold claim. He really wants to demystify technical analysis, make it something an active individual investor can actually use.
Which is interesting because right off the bat, he takes on that old saying, time in the market beats timing the market.
Right, the buy and hold mantra.
Exactly. A lot of pros swear by it. But Arnold, he pushes back. He argues that if you put in the effort, if you understand the technical side, timing can be, and these are his words, accurate and very profitable.
So it's not just a lucky guess for him. It's a discipline.
Absolutely. He sees it as something for the active investor or the seasoned professional, someone who wants to be in the driver's seat using these, quote, modern principles of technical analysis.
Not for passive observers, then.
Definitely not. He even talks about two roads to success.
Yeah.
Different styles, really. You've got the picker.
Okay, the picker.
Yeah, the one trying to nail the exact bottom or top, using all the technical tools to find that precise turning point, like a sniper.
Right. High precision, maybe high risk.
Could be. Then there's the follower. This person waits. Waits for the trend to really show itself. Waits for confirmation, then jumps on board.
Less about the absolute perfect entry, more about catching the main move.
Exactly. Riding the confirmed momentum. Both need technical skill, he argues, but they reflect different personalities, different risk appetites.
Interesting. Which one feels more like you, I wonder? But, okay. He also hits us with some warnings, right? These fatal errors people make.
Oh, yeah, crucial stuff. Number one, being too anxious, feeling you have to do something, often with too much money on the line.
Impatience.
And number two, getting sucked in by the noise, listening to news, tips, whatever, instead of sticking to your own technical work. He calls us social animals reacting emotionally.
Huh. That hits close to home sometimes.
Doesn't it? And that leads straight to his third error, maybe the biggest one. Not having a simple set of rules, or even worse, having rules but ignoring them.
The discipline factor.
Totally. That's when fear or greed or just boredom takes over and you start making random moves, which completely destroys any systematic edge you might have had.
And this really sets up why he thinks technical analysis actually works, doesn't it? It's about decoding that behavior.
Precisely. He argues it's not magic. It's studying these chart formations, these patterns, head and shoulders, flags, pennants, all that stuff.
Okay.
He says these aren't just random squiggles. They're the visual record of market psychology. They show buying and selling pressure, accumulation, distribution.
So the collective emotions, hope, fear, greed.
Exactly. All mapped out in the price action. You're literally reading the market's mind, or at least its mood swings, reflected in the charts.
That's a powerful concept. Okay, so if we're reading the market's mood, we need the language, the tools. Where does Arnold start building that foundation?
He starts right at the beginning. Basics of technical analysis and charting. And he's very clear. This approach focuses only on price and volume patterns. Forget earnings reports, forget news headlines, for this purpose anyway.
Just the chart.
Just the chart. He introduces different types, like simple high-low charts, the more detailed open high-low closed bar charts, even weekly charts for that longer-term view. Each gives you a slightly different angle on the price action.
Got it. So you've got your charts. Now what? How do you start interpreting them? Arnold puts a lot of emphasis on identifying trends, right?
Yeah, absolutely fundamental. A trend, in his view, is just supply versus demand playing out. Prices going up consistently, demand's winning. That's your uptrend, the bullish phase.
And falling prices.
Supplies in charge. That's the downtrend, the bearish phase. He talks about different lengths too, minor trends lasting weeks, intermediate ones for months. and the big major trends that can go for months or years.
And trend lines help you see these.
That's the idea. You draw them on the chart. For an uptrend, connect the progressively higher bottoms, like drawing a line under the rising steps.
Okay.
For a downtrend, connect the successively lower peaks, like drawing a line over the descending staircase.
And the key moment is when the price crosses that line.
That's often a big signal, yeah. He calls it a valid penetration. When price breaks decisively through a trend line, it strongly suggests the trend might be reversing course.
Might be changing direction.
Exactly. But he also mentions things like pullbacks or throwbacks, these little counter moves where the price temporarily dips back towards the broken trend line before continuing the new trend. It's like a test.
A retest, yeah.
And he introduces trend channels too. You draw a parallel line to your main trend line, creating sort of a pathway for the price. It can help define potential buy or sell zones within the trend itself.
Okay, so price shows the what. But Arnold insists volume tells you the how much, the conviction behind it, like the difference between a whisper and a shout.
Great analogy. Volume, just the number of shares traded, is his key confirmation tool. Is the crowd agreeing with this price move?
Right.
So high volume when prices rise. That confirms strong demand. He calls it demand volume. High volume when prices fall. That confirms strong selling pressure, supply volume.
And low volume.
Low volume can suggest a lack of conviction. Maybe the move isn't sustainable. Arnold lays out some basic rules. Rising prices on rising volume, bullish sign. But rising prices on falling volume, maybe a warning sign.
Look at weakness potentially.
Potential weakness, yeah. And conversely, falling prices on rising volume, that confirms the downtrend. But falling prices on falling volume, that could actually be a subtle sign of strength. Maybe the selling is drying up.
Interesting. So it's not always intuitive.
Not always.
Yeah.
Volume adds that crucial layer of context. It tells you if the big money is participating or if it's just noise.
All right, so we have trends, we have volume confirming them. Now, how do we spot the actual turning points? The moments the trend might die and reverse. Arnold talks a lot about reversal patterns.
He does, and he stresses they aren't crystal balls, nothing is. But some patterns have a higher probability than others. He highlights the head and shoulders pattern, both tops and bottoms, as one of the most reliable.
The classic one.
Yeah, the classic. And the psychology makes sense, right? For a top, buyers make a push, left shoulder, then a stronger push, the head, but they fail on the next attempt, right shoulder. Breaking the neckline, the support level formed by the lows between those peaks, is the signal. It suggests the buying power is exhausted.
The energy's gone.
Pretty much. He also covers double tops and double bottoms. Think of an M shape for a top or a W for a bottom. Price hits a level, pulls back, tries again, and fails. It shows a clear ceiling or floor the market respects.
You can really visualize the struggle there. But what about less dramatic turns? Those slow, grinding shifts?
He covers those too. Things like rounding tops or saucer bottoms. These are much more gradual, showing a slow erosion of buying or selling pressure over time. Like a big ship slowly turning.
Less obvious, maybe harder to spot.
Maybe takes more patience, yeah. Then you have things like wedge formations, where the price range gets tighter and tighter, converging towards a point, often signals a breakout is coming, sometimes a reversal. And island reversals, those are pretty dramatic actually, where gaps leave a whole section of trading isolated, signaling a sharp emotional shift.
You mentioned gaps there, those empty spaces on the chart. What's their significance according to Arnold?
Gaps show intensity, a sudden imbalance. Arnold distinguishes between different types. A breakaway gap often happens right at the start of a new trend, showing strong conviction.
Like punching through a level.
Exactly. Then there's a measuring gap, sometimes called a runaway gap, that tends to occur mid-trend and can sometimes help project how much further the trend might go.
Oh, interesting, like a halfway marker.
Sort of, yeah. And then critically, the exhaustion gap, which appears near the end of a move. It looks like a final burst of energy, but it often signals the trend is out of steam. Knowing which gap is key.
Okay, so patterns and gaps help identify potential turns. But markets don't just reverse. They often pull back, right? Retrace.
Crucial point. Arnold emphasizes retracement theory. Markets breathe. They move in waves. After a strong run up or down, prices very often retrace or pull back a portion of that prior move before continuing.
And there are specific levels to watch.
Yeah, he highlights common retracement percentages, drawing on work by people like W.D. Gann and Fibonacci, levels like 38.2%, 50%, 61.8%, even simple fractions like 1/3 or 2/3. These often act as invisible support or resistance levels where the pullback might stop.
Like psychological anchors from the previous move.
That's a good way to put it, market memory.
Which brings us neatly to support and resistance itself. These seem like cornerstone concepts.
Absolutely fundamental. Support is a price level where buying interest is strong enough to stop prices from falling further. Think of it as a floor.
Okay.
Resistance is the opposite, a price level where selling pressure is strong enough to stop prices from rising. An overhead ceiling.
In a psychology, why do these levels form?
Often, it's based on past price action. A previous peak where sellers came in before often becomes resistance next time up. Why? Because people who bought at that old high might be eager to sell and get out even.
Break-even selling.
Right. And previous lows often become support because buyers who missed out before might see it as a good entry point, or sellers might take profits. It's where past decisions create future barriers.
We're building quite the toolkit. Let's add speed. Arnold talks about momentum. What's that telling us?
Momentum is about the rate of change. How fast is the price moving? Is it accelerating or decelerating? He uses a simple 5-day momentum calculation. Today's price minus the price 5 days ago.
Simple enough?
Yeah, but powerful. A rising momentum line suggests increasing buying pressure, even if the price itself isn't making huge gains yet. Falling momentum suggests waning enthusiasm. It can be an early warning signal.
Before the trend actually turns.
Often, yes. He also discusses plotting this as a momentum oscillator. This helps identify overbought conditions where the price has perhaps moved up too far, too fast, or oversold conditions on the downside. Signals the market might be stretched and due for a correction or consolidation.
Okay, so price, volume, patterns, momentum. Next up, moving averages. These are everywhere.
They really are. Think of them as smoothing out the day-to-day price noise to reveal the underlying trend more clearly. A simple moving average just averages the closing price over a set number of periods, say 20 days, 50 days, 200 days.
Longer periods, smoother line shows the longer trend.
Exactly. Shorter periods react faster to recent price changes. He also mentions weighted moving averages, which give more significance to the most recent prices, making them even more responsive.
And how do traders use them typically?
A very common strategy is the crossover. When the actual price crosses above its moving average, it can be a buy signal. When it crosses below, a sell signal. Or you might use two moving averages. A faster one crossing above a slower one is bullish and vice versa.
Got it. And then there's a specific volume indicator he focuses on balance volume, OBV.
Yes, Joseph Granville's OBV. It's a clever way to track cumulative volume flow. Basically, on up days, you add the volume. On down days, you subtract it. It tries to measure whether volume is flowing into or out of a stock over time.
What are you looking for with OBV?
You want to see OBV confirming the price trend. If prices are rising and OBV is also making new highs, that confirms accumulation buyers are in control. If prices are falling and OBD is falling, that confirms distribution sellers dominate.
And divergences are key.
Hugely important. If the price makes a new high, but OBV fails to make a new high, that's a negative divergence. It warns that the buying pressure isn't as strong as the price suggests. The move might be running out of gas. It's a potential sell signal, or at least a caution flag.
Okay, that's a lot of tools for analyzing individual stocks or markets.
Yeah.
But Arnold also zooms out, right, to the broader market context. He mentions Dow theory.
Yeah, the granddaddy, as he calls it. It's about looking at the major market averages, traditionally the Dow Jones Industrial Average and the Transportation Average, to gauge the health of the overall market.
What are the core ideas?
Key tenets are: the averages discount everything known. There are 3 types of market trends: primary, secondary, minor. The averages must confirm each other. If industrials are strong but transports are weak, be cautious. Volume confirms the trend, and a trend stays in effect until a clear reversal signal. It's about the big picture.
And beyond the averages, he looks at market breadth.
Right. Breadth indicators measure how widespread the participation is in a market move. Is it just a few big stocks pulling the average up, or are most stocks moving together?
Like the advanced decline line.
That's the most common one, yeah. You track the number of stocks advancing versus declining each day. A rising AD line confirms a healthy bull market. If the main average is hitting new highs but the AD line isn't following, that's another divergence, suggesting underlying weakness.
So, breadth confirms the health of the trend. What about gauging the market's mood directly? Sentiment indicators.
Yeah, trying to measure investor psychology. Things like the short interest ratio, high short interest, lots of bets against the market can actually be bullish from a contrarian viewpoint.
Because those shorts eventually had to buy back.
Exactly, potential future demand. He also mentions things like tracking odd lot trading, small trades, often seen as less sophisticated investors, or advisory sentiment, what newsletters are recommending. Often, extreme readings in these are used as contrary indicators do the opposite of the crowd.
Fascinating. It feels like we've got this arsenal of technical tools now. It sounds almost easy.
Hmm.
But Arnold includes a whole chapter on why people lose, doesn't he?
Oh, absolutely critical. It's the reality check. He points out common traps. The option trap, buying cheap, out-of-the-money options that expire worthless. The high commission trap, churning your account and paying too much in fees.
Yeah, those are practical.
Then there's the guru trap, just blindly following someone else's tips without doing your own homework. And maybe the biggest category, the emotional pitfalls.
Fear and greed again.
Fear, greed, hope, impatience, overconfidence, lack of discipline, all this stuff that makes us human and makes trading hard. He also mentions the small account trap. Trying to trade seriously with too little capital makes it tough to manage risk properly.
So knowing the tools isn't enough. You have to master yourself.
That seems to be his core message, really, which leads to his advice on putting it all together. Portfolio selection and developing a trading system.
A plan.
A concrete plan. Rules for entry, exit, risk management, position sizing,
Yeah.
combining the technical signals into a coherent strategy that fits you, not just randomly applying indicators and applying it consistently.
And this applies beyond stocks.
He touches on it, yeah.
Okay.
Suggests the principles work for commodities, options, other markets too, although each has its own nuances, of course.
It really does seem to come full circle, back to the mind game. The psychological side.
Absolutely. He finishes by hammering home the importance of emotional discipline, patience, self-awareness. You have to control your impulses, stick to your plan even when it feels uncomfortable, avoid getting swept up in the market's daily drama. Without that mental fortitude, he suggests, even the best technical analysis will likely fail you.
Okay, so we've really journeyed through Curtis Arnold's Timing the Market. For the basic why of technical analysis, reading market psychology, through all the tools like trends, volume, patterns, indicators, right up to the crucial psychological discipline needed and the pitfalls to avoid.
Yeah, and his central argument remains pretty bold. Market timing isn't impossible. It's difficult, yes, requires work, requires discipline, but with the right technical approach, he believes it can be a powerful tool for you, the active investor.
He definitely challenges that passive buy and hold is the only way thinking. He offers a framework, a set of tools for engaging directly with market movements based on the market's own data. It's a call to be informed, active, and maybe most importantly, disciplined.
A call to take control, in a way.
Right. So as you think about all these classic tools and patterns, Arnold lays out head and shoulders, trend lines, volume analysis, cycles tools often developed decades ago. Consider this. The market reflects collective human emotion, right?
That's the theory.
Well, in today's world, with algorithms trading in microseconds, with social media driving sentiment shifts instantly, with AI maybe spotting patterns humans can't even see what new patterns might be forming. What subtle signals, born from this digital landscape, might be hiding in plain sight, patterns Arnold couldn't have anticipated. How could you potentially adapt these classic technical strategies to decipher the market's emotions today? Maybe finding an edge in signals others haven't yet learned to read,